Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hang Lung Group Limited annual report. Hang Lung Group Limited is a diversified company that operates through various segments to provide a wide range of businesses and services. The company's primary focus is on property development, which includes developing properties for sale and lease across different categories, such as retail, office, residential, and serviced apartments. In addition to property development, Hang Lung also operates hotels, shopping malls, office and industrial premises, residential premises, and car parking bays. This indicates that the company has a significant presence in the hospitality and real estate sectors. Furthermore, it offers various services including property management, financial services, apartment operation and management, property agency, hotel investment services, and property investment services for rental income. Overall, Hang Lung Group Limited's business operations span across multiple industries, making it a comprehensive player in the market. Its diverse range of businesses and services enable it to cater to different customer needs and provide a one-stop solution for various requirements. The Hang Lung Group's stock price has skyrocketed by approximately 70% to 74% over the past year, driven by a combination of factors that have contributed to a positive market sentiment in the Hong Kong real estate sector. One key factor is the recovery of the Hong Kong property market, which began in January 2026. This upturn was fueled by signs of market recovery and an upgraded residential price forecast from CEDI. Hang Lung Group's stock rose by 2.04% on January 21, 2026, as part of this broader positive trend. Another significant factor is the anticipation of strong financial performance, particularly with regards to the company's 2025 annual results and dividends. The scheduled board meeting in January 2026 to review and approve these results was met with a positive investor response, leading to a gain of approximately 3.09% for its ADR. The company's strategic expansion and partnerships have also played a crucial role in driving up the stock price. In December 2025, Hang Lung Properties joint venture with Shanghai Jiubai Group Co. Limited for a commercial development on Nanjing Road West, Shanghai, was announced. This partnership capitalized on Shanghai's booming debut economy, bolstering growth in the city's commercial real estate sector. Furthermore, favorable analyst sentiment and luxury retail recovery have contributed to the company's success. Analysts observed a sustained recovery in retail tenant sales, which positively impacted mall operations and, consequently, the share price. This improving sales outlook created favorable conditions for Hang Lung's commercial property portfolio, leading to higher long-term valuation targets and buy recommendations from analysts. Overall, the cumulative effect of these positive news events and underlying market conditions has largely accounted for the substantial appreciation in Hang Lung Group's stock price during the past year. Hang Lung Group Limited market capitalization of $23 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Hang Lung Group Limited holds a significant advantage in their industry. Hang Lung Group Limited trades at a higher price-to-earnings ratio of 16 times and a lower price-to-book ratio of 0.23 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.11%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the company's operations can be summarized as follows. Revenue growth was driven by several factors, including a significant increase in hotel revenue, strong performance from malls such as Plaza 66 and Olympia 66, and growth in residential and serviced apartments. The Grand Hyatt Kunming also saw a remarkable 265% revenue growth in its first year of operation. Additionally, rental revenue from mall portfolios rose by 1%, while tenant sales increased by 4% in RMB terms. On the other hand, revenue decline was attributed to various factors, such as a decline in property leasing and sales revenue, softness in the office leasing market in Chinese mainland and Hong Kong, and negative impacts from government policies. Specifically, properties like Heartland 66, Forum 66, and Grand Gateway 66 experienced significant declines in revenue due to changes in tenant mix, marketing initiatives, and rental reversions. The net income of the company experienced a mixed trend in the given period. Initially, it showed a decline of 13% in Hong Kong dollars and 12% in renminbi, indicating a decrease in profitability. However, this downward trend was reversed when the net income increased by HK$21 million, representing an impressive growth of 84%. This significant increase suggests that the company's financial performance improved substantially. The profit margins also underwent a change during this period. The operating profit margin decreased from 42.1% to 40.6% in Hong Kong dollars and from 41.9% to 39.4% in renminbi, indicating a slight decline in profitability. This reduction in profit margins could be attributed to various factors such as increased competition, higher operational costs, or a decrease in sales prices. Despite this decline, the company's net income showed an upward trend, suggesting that it was able to offset some of these losses through other means. The company's financial performance has shown significant improvement in recent years. One notable indicator of this growth is the generation of positive operating cash flow. In 2025, the company achieved an operating cash flow of HK$23,805, marking a substantial milestone in its financial journey. This achievement demonstrates the company's ability to manage its operations efficiently and generate sufficient funds from its core business activities. The positive operating cash flow also indicates that the company is capable of covering its expenses and investing in growth initiatives without relying on external financing. Overall, this development bodes well for the company's future prospects and reinforces investor confidence in its financial stability. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, it may seem counterintuitive that total debt decreased from HK$57,794 million to HK$54,837 million, while net debt increased from HK$46,977 million to HK$48,045 million. However, this discrepancy can be attributed to the company's financial restructuring efforts. A closer look at interest expenses reveals a notable increase. Finance costs rose from H$947 million in 2024 to H$991 million in 2025, while net interest expense increased from HK$187 million to H$950 million over the same period. This upward trend is concerning and suggests that the company may be facing higher borrowing costs or increased debt servicing expenses. The decrease in interest income from HK$60 million to HK$41 million also contributes to the overall increase in net interest expense. While this reduction may not seem significant, it still adds to the company's financial burden. Overall, these changes indicate a shift towards higher interest expenses for the company, which could have implications for its future profitability and cash flow management. The performance of various segments and regions within the company's portfolio has been mixed. On the negative side, the office sector saw a decline of 7% in revenue, while the retail portfolio in Hong Kong experienced a 4% drop in rental revenue and flat tenant sales. The office segment in Hong Kong also suffered a 2% decrease in revenue. In contrast, some segments have shown improvement. The malls within the company's portfolio reported a 1% increase in rental revenue, indicating a positive trend. This disparity highlights the need for targeted strategies to address underperforming areas and build on successful ones. Management is optimistic about the company's outlook, citing several key strategies to drive growth. One major focus area is expanding into core cities through new projects, which will help increase visibility and scale. Additionally, management plans to prioritize selective capital-efficient reinvestments to maximize returns. The retail sector is expected to stabilize due to improving consumer sentiment, with a gradual improvement anticipated in the mainland retail leasing market by 2026. To capitalize on this trend, the company will focus on experiential placemaking and value-driven spending, enhancing customer experience and driving growth. Westlake 66 is identified as a key growth driver, with over 90% of its retail space already secured. This strategic investment is expected to contribute significantly to the company's expansion plans in core cities. Overall, management's strategy emphasizes selective investments, experiential retail, and strategic growth initiatives to drive long-term success. The company has made significant investments through acquisitions, with one notable example being the purchase of a property located at 812A Wilson Road in Jardines Lookout on Hong Kong Island. This acquisition was completed in January 2025 and is documented on page 19 of the relevant records. In terms of divestitures, there are no recorded instances mentioned in the provided summaries. The company has a history of paying dividends to its shareholders. The most recent information available indicates that the dividend per share for both 2024 and 2025 is $0.86. Furthermore, the breakdown of the dividends paid in 2025 shows that the interim dividend was HK 65 cents and the final dividend was HK 21 cents. In total, the company paid out a significant amount of money to its shareholders in 2025, with the dividends totaling HK $186 million for the interim payment and HK $185 million for the final payment. That concludes the financial summary for Hang Lung Group Limited. Feel free to comment below, and I will be happy to answer them when possible.